My book, which is titled Boom Bustology, Spotting Financial Bubbles Before They Burst, is really about taking a liberal arts or a multiple lens approach to identifying bubbles. And so I bring to bear lenses such as microeconomics, macroeconomics, psychology, politics, and even herd behavior lenses to tip the odds of identifying a bubble before it bursts, which is presumably more useful. One of my lenses that I look through is the macroeconomic lens, and that's really looking at credit conditions and to see whether or not money is priced appropriately. And for political reasons, that's another lens I use, I would argue that today money is mispriced and it's probably too cheap. And when money is mispriced, it's misused, misallocated. So I am fully of the belief that today the current price of money, interest rates if you will, are manipulated to below their standard level or the appropriate level, let's say, resulting in a misuse and misallocation of capital. So I think that creates bubbly conditions in various areas, in various asset markets. Well, I think there's a couple of different dynamics that are transpiring within the investment climate today. One of the more substantial ones, perhaps, is the rise of passive investing. And so I do think that causes a herding mentality within stocks. So dispersion across stocks is actually dropping, and I think one of the primary drivers of that is the rise of passive investing. I'm really concerned about that for one reason. The fundamental basis upon which passive investing has been justified is a valid price mechanism. And the valid price mechanism is usually an output of active buyers and sellers negotiating what a stock should be worth. If it's overvalued, someone will sell it. If it's undervalued, someone will buy it. There is this tendency towards an accurate, insofar as that has any meaning, price. With passive investing, it's based on inflows. All stocks will move up that are in the index. Outflows, all stocks in the index will move down because there will be selling pressure if there's, if there's outflows, and buying pressure if there's inflows. The quality of the individual company matters less. The actual price mechanism used to determine that, or the actual buying and selling pressure to determine the actual price of an individual security, is being lost as passive investing gains share. That is very concerning to me because fundamentally it takes away the basis upon which passive investing is justified. And so I think it just creates confusing dynamics and lots of distortions to underlying prices, and that fundamentally leads to misallocated capital, and that creates bubbles.